With the massive GOP tax reform bill heading to the White House for a jubilant President Trump's signature, it's time for the number crunching to move from Capitol Hill to your kitchen table. Do the pros and cons found in the 500-plus pages of legislative language add up to good news or bad news for your family's bottom line? Most of the new rules go into effect in less than 2 weeks, on January 1, 2018, but will not affect your 2017 tax return due in April. In almost every case, that return is covered by the old rules. Also, note that many of the changes affecting individuals will expire after 2025 unless a future Congress acts to extend them. Most of these rules would revert to those in effect in 2017. Stay tuned for a look at key provisions of the new tax law that could affect your pocketbook. 1. Bigger standard deduction. Goodbye exemptions. A hallmark of the new law is the near doubling of the standard deduction to $12,000 on single returns, $18,000 for head of household filers and $24,000 on joint returns, up from $6,350, $9,350 and $12,700 in 2017. Congressional analysts say bulking up the standard deduction will let more than 30 million taxpayers avoid the hassle of itemizing write-offs on their tax return because the bigger standard deduction would exceed their qualifying expenses. As under present law, individuals age 65 or older and blind people get even higher standard deductions. To 65-year-olds filing a joint return, for example, would add $2,500 to the $24,000 standard deduction. An individual taxpayer age 65 or older would add $1,550, bringing the standard deduction to $13,550. In exchange for the bigger standard deductions, personal exemptions, the $4,050 deduction for each exemption claimed on the return, are eliminated. So a married couple with 4 kids would lose $24,300 in exemptions in exchange for the $11,300 boost in their standard deduction. 2. Say hello to a higher child tax credit and a new family tax credit. Starting in 2018, the $1,000 tax credit for each child under age 17 is doubled to $2,000, with $1,400 of the credit refundable to lower-income taxpayers. Additionally, the package significantly increases the income phase-out thresholds. The credit begins to phase out for couples with adjusted gross incomes over $400,000, up from $110,000 in 2017, and $200,000 for all other filers, up from $75,000. In addition to the enhanced child tax credit, there is a new, non-refundable credit of $500 for each dependent who is not a qualifying child, including, for example, an elderly parent or disabled adult child. This credit would phase out under the same income thresholds. 3. Tax Bracket Bingo, Part 1. The proposal to shrink the number of income tax brackets to 4 was left on the cutting room floor. The new law keeps 7 tax brackets, but with different rates and different breakpoints. For example, not only is the top rate lowered from 39.6% to 37%, but that rate also kicks in at a higher income level. And, note that whatever new bracket you fall in, more of your taxable income will be hit with lower rates. On the other hand, restrictions or elimination of some tax breaks probably may mean more of your income will be taxed. 3. Tax Bracket Bingo, Part 2. There are also new tax brackets for head of household filers as well as for married couples who opt to file separate returns. Note that inflation indexing of the tax brackets and various tax breaks is altered in the tax package. Critics complain that this amounts to a surreptitious tax hike that over time would nail nearly all individual filers. Currently, the federal income tax brackets, standard deductions and many other tax items are adjusted annually based on the government-calculated Consumer Price Index. Economists economists have argued that the version of the CPI used now tends to overstate actual inflation because the formula doesn't account for how people change their spending patterns as prices rise. They claim that a chained index is a far better measure of inflation. A chained CPI would result in lower inflation adjustments than the current index. The new law uses a chained CPI for inflation indexing. As a result, there would be smaller annual increases in tax brackets, standard deductions and other breaks. 4. Squeezing homeowner tax breaks. Lawmakers decided to reduce, from $1 million to $750,000, the amount of debt on which homeowners can deduct mortgage interest. The limit applies to mortgage debt incurred after December 15, 2017. To buy or improve a principal residence or second home. Older loans are still subject to the $1 million cap. The law also bans the deduction of interest on home equity loans, and this change applies to both old and new home equity debt. Interest accrued on home equity debt after December 31, 2017, is not deductible. A proposal to extend the time you must own and occupy a home to qualify for tax-free profit when you sell it was dropped from the final legislation. As in the past, the law allows you to shelter up to $250,000 of such profit, or $500,000 if you're married, as long as you have owned and lived in the house for 2 of the 5 years before the sale. 5. Deduction for state and local taxes. One of the most valuable tax deductions allowed for individuals, the write-off for what you pay in state and local income, sales and property taxes, is getting squeezed. Starting in 2018, the new law sets a $10,000 limit on how much you can deduct of the state and local taxes you pay. A plan to limit the write-off to property taxes only was scrapped. You can deduct any combination of state and local income or sales taxes or residential property taxes, up to the $10,000 cap. Don't assume that you can beat this crackdown by prepaying 2018 taxes before December 31, 2017. Although a fourth quarter 2017 estimated state income tax bill due in January or a property tax bill due in January that covers 2017 can be paid in 2017 and deducted on your 2017 return without being subject to the new limit, congressional tax writers specifically noted that prepaying 2018 taxes won't earn a fatter deduction. Note this, even under the new rules, property and sales taxes will remain deductible for taxpayers in a business or for-profit activity. For example, if you own a residential rental property, you can continue to fully deduct property taxes paid on that property on Schedule E. 6. Casualty losses. Going forward, the new law greatly restricts the opportunity for individuals who suffer unreimbursed casualty losses from sharing the pain with Uncle Sam. Under the old rules, such losses were deductible by those who itemized to the extent the loss exceeded $100 plus 10% of their adjusted gross income. Starting in 2018, the law allows a deduction of such losses only if they occur in a presidentially declared disaster area. There's the opposite of a crackdown for 2016 and 2017 losses in presidentially declared disaster areas. The new law permits individuals who suffered such losses to deduct the loss without reducing the write-off by 10% of adjusted gross income. To be deductible under this rule, the loss must exceed $500. Also, for covered losses, the deduction is available even for those who claim the standard deduction. 7. Estate tax dodges a bullet. Again, efforts to kill the federal estate tax fell short, but the new law doubles the amount that can be left to heirs tax-free in 2018, to about $11 million for couples and about $22 million for married couples. The amount will rise each year to keep up with inflation, but, as with many changes in the law, this one expires at the end of 2025, when the tax-free amount will revert to earlier levels. The law does not change the rule that steps up the basis of inherited property to its value on the date the benefactor died. As in the past, any appreciation during the life of the previous owner becomes tax-free. 8. Medical deductions survive and get healthier. Despite efforts to eliminate the deduction for medical expenses, the new law is actually more generous than the old one. Under the old rules, medical expenses were deductible only to the extent they exceeded 10% of adjusted gross income for 2017 and 2018. However, the threshold drops to 7.5% of AGI. Come 2019, the 10% threshold returns. 9. alimony becomes tax-free. But not until 2019. A big change is coming for divorce. In the past, alimony paid under a divorce decree was deductible by the ex-spouse who paid it and treated as taxable income by the recipient. Starting with alimony paid under divorce or separation agreements executed after December 31, 2018, the reverse will be true. Pairs will no longer get to deduct alimony, but the payments will be tax-free for the ex-spouse who receives them. That's the same rule that has and will continue to apply to child support payments. 10. Status quo for teachers' tax break. The Senate wanted to double to $500 the tax deduction teachers can claim for using their own money to buy classroom supplies. The House wanted to eliminate this write-off altogether. In the end, neither happened. The deduction stays at $250. 11. Squeezing commuter benefits. The new law eliminates, starting in 2018, the rule that allows employers to deduct up to $260 a month per employee for the cost of transportation-related fringe benefits, such as parking and transit passes. Employees can still use pre-tax money to cover such expenses, but employer subsidies may dry up. The new law puts the kibosh on the federal bike commuter benefit that had allowed employers to provide employees up to $20 a month tax-free to cover bike-related expenses. 12. Tax breaks for students survive. The effort by the House of Representatives to eliminate the deduction for interest paid on student loans and to begin taxing tuition benefits earned by graduate students were snubbed by the Senate. Neither proposal made it into the new law. As under the old law, you can continue to deduct up to $2,500 a year of interest paid on student loans. This write-off can be claimed by those who take the standard deduction, but it phases out at higher income levels. Also, tuition waivers and discounts received by graduate students will retain their tax-free status. The new law also declares that, if a student loan is discharged due to the borrower's death or permanent disability, the amount discharged will no longer be considered taxable income. 13. A reprieve for dependent care plans. The House of Representatives called for preventing working parents from setting aside pre-tax money in dependent care flexible savings accounts to pay for child care costs. The Senate blocked the effort, so the tax break remains in the law. Parents can continue to set aside up to $5,000 pre-tax in these accounts. 14. No more Roth do-overs. The new law will make it riskier to convert a traditional individual retirement account to a Roth. Under the old law, you could reverse such a conversion and eliminate the tax bill by recharacterizing the conversion by October 15th of the following year. Starting in 2018, such do-overs are done for. Conversions will be irreversible. 15. Investors' control over tax on capital gains. For a while, it looked like Congress might restrict the flexibility investors have to control the tax bill on their profits. Investors who have purchased stock and mutual fund shares at different times and different prices are allowed to choose which shares to sell in order to produce the most favorable tax consequences. You can, for example, direct your broker to sell shares with a high tax basis, basically, what you paid for them, to limit the amount of profit you must report to the IRS, or, if the shares have fallen in value, to maximize losses to offset other taxable gains. Your gain or loss is the difference between your basis and the proceeds of the sale. The Senate called for eliminating the option to specifically identify which shares to sell and instead impose a first-in first-out (FIFO) rule. The oldest shares would be assumed to be the first sold because it is assumed that the older shares likely have a lower tax basis. This change would trigger the realization of more profit sooner rather than later. In the end, though, this idea fell by the wayside. Investors can continue to specifically identify which shares to sell to arrange for the most favorable tax outcome. 16. 0% capital gains rate survives. The new law retains the favorable tax treatment granted long-term capital gains and qualified dividends, imposing rates of 0%, 15%, 20% or 23.8%, depending on your total income. In the past, your capital gains rate depended on what tax bracket you fell in. But, with the changes in the brackets, Congress decided to set income thresholds instead. For example, the 0% rate for long-term gains and qualified dividends will apply for taxpayers with taxable income under about $38,600 on individual returns and about $77,200 on joint returns. 17. Like-kind exchanges survive, but only for real estate. Generally, an exchange of property is a taxable transaction, just like a sale. But the law includes an exception when investment or business property is traded for similar property. Any gain that would be triggered by the sale of such property is deferred in the case of a like-kind exchange. This break has applied to assets such as real estate and tangible personal property such as heavy equipment and artwork. Going forward, though, the new law restricts its use to like-kind exchanges of real estate, such as trading one rental property for another. It's estimated that the change would cost affected taxpayers more than $30 billion over the next 10 years. 18. Fewer taxpayers need fear the AMT. Originally, both the Senate and the House bills called for eliminating the alternative minimum tax, a parallel tax system developed more than 40 years ago to ensure that the very wealthy paid some tax. Taxpayers who may fall into the AMT zone have to calculate their taxes twice to determine which system applies to them. In a last-minute change, though, the new law retains the individual AMT, but limit the number of taxpayers ensnared by it by significantly hiking the AMT exemption. The new law does abolish the corporate AMT. 19. Tax relief for pass-through businesses. The new law slashes the tax rate on regular corporations, sometimes referred to as C corporations, from 35% to 21%. Starting in 2018, the law offers a different kind of relief to individuals who own pass-through entities such as S corporations, partnerships and LLCs which pass their income to their owners for tax purposes, as well as sole proprietors who report income on Schedule C of their tax returns. Starting in 2018, many of these taxpayers will be allowed to deduct 20% of their qualifying income before figuring their tax bill. For a sole proprietor in the 24% bracket, for example, excluding 20% of income from taxation would have the effect of lowering the tax rate to 19.2%. The changes to the taxation of pass-through businesses are some of the most complex provisions in the new law, in part because of lots of limitations and anti-abuse rules. They're designed to help prevent gaming of the tax system by taxpayers trying to have income taxed at the lower pass-through rate rather than the higher individual income tax rate. For many pass-through businesses, for example, the 20% deduction mentioned above phases out for taxpayers with incomes in excess of $157,500 on an individual return and $315,000 on a joint return. At the end of the day, most individuals who are self-employed or own interests in partnerships, LLCs or S corporations will be paying less tax on their pass-through income than in the past. We presented the following 3 scenarios to officials at the National Federation of Independent Business, in each case assuming a joint return and that other income does not trigger the high-income phase-out. A yoga instructor whose only income is $35,000 of self-employment reported on Schedule C. A freelance writer whose only income is $120,000 of self-employment income reported on Schedule C. A consultant who establishes a single-member LLC and whose only income is $250,000 earned from a variety of clients and reported on Schedule C. In each case, NFIB says the 20% deduction would apply. 21. Deductions that lots of people take, get the axe but 2 credits survive. The new law eliminates a popular deduction for moving expenses. The deduction, which was available to itemizers and non-itemizers, allowed taxpayers to deduct the cost of a job-related move. Going forward, only members of the military can claim it. The new law also repeals all miscellaneous itemized deductions subject to the 2% of AGI threshold, including the write-off for tax preparation fees, unreimbursed employee business expenses and investment fees. The House of Representatives version of the tax overhaul wanted to scrap the credit for the elderly and the disabled, which is worth up to $1,125 to qualifying low-income taxpayers. It also unplugged the credit for plug-in electric vehicles, which is worth of up $7,500. The Senate refused to go along, though, so both tax breaks will continue. 22. Kiddie tax gets more teeth. Under the old law, investment income earned by dependent children under the age of 19, or 24 if a full-time student, was generally taxed at the parent's rate, so the tax rate would vary depending on the parent's income. Starting in 2018, such income will be taxed at the same rates as trusts and estates, which will produce a much higher tax bill. The top 37% tax rate in 2018 kicks in at $600,000 for a married couple filing a joint return. That same rate kicks in at $12,500 for trusts and estates, and, now, the Kiddie tax too. 22. Individual mandate, dead or alive. The new law does repeal the individual mandate, the requirement that demands that you have health insurance or pay a fine, but not until 2019. For 2018, the mandate is still in place. 23. With or withholding. The new law is causing quite a ruckus in payroll offices around the country. Under the old law, the amount of tax withheld from paychecks was based on the number of allowances employees claimed on W-4 forms, and the number of allowances was tied closely to the number of exemptions the worker claimed on his or her tax return. Starting in 2018, there are no exemptions, so there's a mad scramble going on to figure out how to set withholding under all the new rules. The new law orders the Secretary of the Treasury to come up with a new system, but also says 2018 withholding can be based on the old rules. Keep an eye out on this one. 24. 529 plans aren't just for college anymore. The new law allows families to spend up to $10,000 a year from tax-advantaged 529 savings plans to cover the costs of K-12 expenses for a private or religious school. Previously, tax-free distributions from those plans were limited to college costs. 25. Expanded ABLE accounts. The law expands the uses of these tax-advantaged accounts, which allow families to put aside up to $14,000 a year to cover expenses for a beneficiary with special needs. The money can be used tax-free for most expenses, and account assets of up to $100,000 don't count toward the $2,000 limit for supplemental Social Security income benefits. Under the new law, ABLE beneficiaries will be allowed to contribute their own earnings to the account once the $14,000 contribution limit for gifts by others has been reached. The law also allows parents and others who established a 529 plan for a disabled beneficiary to roll the money into an ABLE account for that individual. However, the rollover would count towards the $14,000 annual contribution limit. 27. Relief for some 401k plan borrowers. The new law would give employees who borrow from their 401k plans more time to repay the loan if they lose their jobs or their plan is terminated. Currently, borrowers who leave their jobs are usually required to repay the balance in 60 days to avoid having the amount outstanding treated as a taxable distribution. Under the new law, they will have until the due date of their tax return for the year they left the job. 26. Relief for some 401k plan borrowers. The new law would give employees who borrow from their 401k plans more time to repay the loan if they lose their jobs or their plan is terminated. Currently, borrowers who leave their jobs are usually required to repay the balance in 60 days to avoid having the amount outstanding treated as a taxable distribution. Under the new law, they will have until the due date of their tax return for the year they left the job.